Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with a beginner's guide to investing. If you've been following the channel, you'll know that I've been promoting the concept of investing and the idea that the sooner you start benefiting from compound growth. And what that means is that the growth that you achieve on your portfolio will start growing itself. So if you take the example of a $100 investment, in year one, if you achieved growth of 10%, that would mean that you had $10 worth of growth. And at the start of year two, your original $100 would now be worth $110. And if you achieve 10% growth on that, then you'll get $11 worth of growth. And at the start of year three, you would then have $121. So your $100 had now grown to $121. And if you achieve 10% growth on that, then you will earn $12.10. So you can start to understand how the growth starts to actually benefit you. It becomes a bigger and bigger pot, and therefore as you achieve more growth, it gets larger and larger. And ultimately the goal here is to get you to the point of financial freedom, where your investments are earning you more money than all of the other things in your life, and you can sit back and enjoy things. You can have a fantastic life. But in order to get there, you need to make a start. And I've had a lot of people sending me messages saying, okay, I buy into the concept, I want to start investing, but where do I start? What do I do? What should be the first investment that I make? And in today's video, we're going to go through the strategy and ideas that you need to put together your growth portfolio. So the first concept that I want to talk about is a cash safety net, because all of the things that we're going to discuss in this video involve risk. If you're investing money, by definition, that investment can go down in value as well as up. So you shouldn't be putting all of your life savings in day one, because you might see your life savings starting to go down in value. And that can be quite demoralizing and also can be very risky if you're living on a budget and you need that money to survive. So I would always suggest having a cash safety net before you start investing. And that cash safety net really depends on your lifestyle, but the recommendation is that you should have somewhere between 3 and 6 months worth of expenses put away in a savings account, just in case you lose your main form of income. So if you lost your job or something happened where you couldn't work for a while, you could use that safety net to just cover all of your expenses. So first and foremost, I want to make sure that everybody is comfortable and safe and isn't gambling their whole life savings at the start of their investment journey. You may get more ambitious as time goes on, as your investments start to grow and you feel more comfortable that they're not going to crash in value. But right at the start of your journey, you need to make sure that you've got a safety net, because I don't want you investing everything that you've got into the markets and then we have a disastrous event, because nobody can control what's going on in the markets. You might pick a great stock, or you might pick some form of investment that you think is a winner in the long term, but if something disastrous happens in the world where all of the markets fall by 10 or 20 or 30% overnight, you don't want to be sitting back nursing all of those losses, worrying about your own personal finances. So a cash safety net is an absolute must before you start making any investments. Now, right at the start of your investment journey, you need to work out a strategy. What is your goal? What are you trying to achieve? Now, I'm going to assume that most people watching this video are looking for long-term growth. We want to see our net worth growing on a regular basis. This video is not a get-rich-quick scheme. I'm not trying to give you investment ideas that are going to double overnight, whereby you could potentially lose all of your money, because that's day trading, that's essentially gambling. People who are looking for share tips on things that are going to double in a short space of time, generally speaking, are gamblers. That isn't a long-term investment strategy. That's just trying to make a quick buck and get out. And usually, in my experience, people who are doing that will get their fingers burned. Because like any form of gambling, at some point you will get it wrong. You'll make a big bet and lose all of it, and that could wipe out all of the profits that you might have made historically. So what we're talking about in today's video is building up a portfolio that you would be happy with for the rest of your life. So this isn't a way of doubling your money in a short space of time. However, I am talking about doubling your money over the longer term. And a really interesting rule of thumb is the rule of 72. And you might not have heard of that, but basically the rule of 72 tells you how long it will take to double your money at the rate that you're growing your portfolio. So in order to use the rate of 72, you simply divide 72 by the rate of growth of your portfolio. So a very easy example is if you've got a portfolio that's growing at 7.2%, then that tells you that it will take 10 years to double your money. So if you can find an investment that gives you a return of 7.2%, you know that your money will double every 10 years. However, if you can get an investment that gives you a return of 14.4%, then you would double your money in 5 years. And equally, if it's 3.6%, then it would take you 20 years to double your money. So I think the rule of 72 is a really good thing to keep in mind, because you can look at your portfolio and you'll start to work out how long it will take to double your money. And doubling your money, I think, is a good early strategy to think about what you want to achieve. Because if you can double your money, then you feel that you've done really well. Now, obviously, you need to take into account inflation, because doubling your money doesn't mean that you'll have twice as much purchasing power in 10 years' time or 5 years' time or 20 years' time, whatever the horizon is. Because if inflation is also rising by 7.2%, for example, then the purchasing power of your money in 10 years' time would be exactly the same as it is today. However, inflation isn't rising at 7.2% in most economies over the long term. The goal for most economies is somewhere between 2 and 4%. So if you can achieve real growth of 7.2%, for example, and inflation is only going up by 2%, then you've got an increase in your purchasing power. And that means that your net worth is going up. So I think the rule of 72 is a really good thing to keep in mind when you're working out your strategy for your investments. And I think doubling your money is a very achievable goal. If I give you an example, the S&P 500 index, which are the 500 largest companies in the USA, over the past 10 years, the S&P 500 index has achieved compound growth of 15.2%. So using the rule of 72, that tells you that your money would have doubled every 4.7 years. And over the past 53 years, since the start of 1970, the index has achieved 10.9% growth, which means that your money would have doubled every 6.6 years. So if you'd have invested back in 1970, your money would have grown more than 8 times over that period. So that gives you a flavour of the sort of returns that you can make by investing into the markets. Now, before we move on to what investments you should be thinking about making, I want to talk about costs, because costs are something that are quite often ignored when people are looking at investments. So you might look at the movement in a share price and think, oh, if I'd have invested in that at the start of the week, and then by the end of the week I'd have sold it, I'd have made a return of 5% or 10%, which is obviously a great outcome in the short space of time. However, it depends how much money you're investing and what costs are involved. And generally speaking, when you're talking about dealing in shares and funds, you'll have to go through some sort of online brokerage. And when you do that, there will be some costs involved. And it depends who you're using. Obviously, the costs will vary depending on the platform. But generally speaking, there will be an initial cost, and there might be a minimum amount. So it could be $5 or $10 as a minimum charge. So if you're investing only $20, for example, and you're using a platform that charges you $5 per trade, then even if you're making a 5% return on that investment, you're going to lose money, because 5% on $20 is only going to be around $1. However, if you're paying a $5 fee, then you're going to lose money even though you'll be making money on the actual share transaction. You need to bear in mind the costs. Now, the example I've given you there is an extreme one, because most people wouldn't be investing $20 if you're paying a $5 fee, and you certainly wouldn't be trading on a weekly basis. But it just raises the issue of costs. You always need to factor it in, because it will bring down your returns. If you're constantly paying lots of trading fees, then you need to take that into account. And equally, if you're paying a management fee to a company who's managing your portfolio for you, whether it be your pension or some other form of investment, then you need to deduct their costs to get to your actual rate of return, because your real rate of return is what you use when you're talking about the rule of 72. That tells you how long it will take to double your portfolio, because the net return is the actual amount that your portfolio is increasing by. Because if somebody's taking lots of costs out, then that basically can be deducted from your profit. And the point of raising costs at this point in the video is that you need to make sure that you're using the lowest cost form of investment, particularly at the start of your journey. You don't want to be making returns and then giving all of that return to some platform or some fund manager. You want to keep it all for yourself. So you want to go for the lowest cost option. Now, you can obviously do your own research in terms of the costs that are involved in online trading platforms. However, if you're based in the USA or the UK, Robinhood, the online share trading platform, doesn't charge any fees or any commission. Now, this video is not sponsored by Robinhood. I'm not promoting their services. I'm just mentioning it because it's a platform that I use because it's very low cost. And therefore, any profit that I'm making from trading on Robinhood goes to me rather than going to the owners of that platform. So cost is a really important thing to factor into your investment journey. Make sure that you're doing it with the minimal amount of cost. So obviously the big question is, what should you be investing into? And I'd like to say at this point in the video that this is not financial advice. I'm not looking to provide you with direct advice as to what you should be investing into. So there won't be any share tips in this video. I'm just talking to you about how you should go about putting together your strategy, because I don't want to be sued for you losing lots of money. But the issue here is whether or not you should invest into shares or funds. And the answer to that, for me, for any investor, is that you should not be investing into individual shares. And the reason why I'm saying that is because it's far too high risk. Now, obviously, you hear about fantastic growth stories such as Nvidia. And when you look at what Nvidia did in 2021, it increased in value by more than 100%. In 2022, it went up by more than 50%, and in 2023, it rose by more than 230%. So clearly, if you'd have put lots of money into Nvidia back in 2021, you'd be sitting on a very healthy profit. It's gone up around 10 times over that period. However, there are lots and lots and lots of other shares that have performed very badly, particularly high growth tech stocks such as Nvidia, because for every single winner, there are lots of losers. There will be lots of other AI related businesses that haven't actually done very well at all. And what I don't want to do in this video is put you off investing by putting money into something that you think might increase 100 times, but actually reduces in value by 50% within a week of you doing it, because early losses are a very good way of killing your investment journey. And the analogy that I'd like to give you in terms of whether you should invest in individual shares or funds is a sports analogy. So if you think about the Kansas City Chiefs, who won the Super Bowl in 2024, if you think about individual shares being like individual players within the Kansas City Chiefs squad, then you could have put all of your money on one player to be the MVP, the most valuable player in the Super Bowl. However, if that player got injured in the first minute of the game, then obviously he's not going to be the MVP. He's not even going to play in the game. However, if you'd have put your money on the Kansas City Chiefs to win the Super Bowl, then it didn't really matter what happened with the individual players. You're betting on the team as a whole, and as the team won, you'd have made all of your money. And the stock market is similar to that analogy. If you're betting on individual shares, something can happen to that individual company. Like an injury in sport, if that company suddenly declares that it's found some sort of problem in one of its markets, or it's got a problem with one of its products, or something happens to wipe out all of its profits, then that stock can fall in value significantly. However, if you're putting your money on the market as a whole, similar to what we're talking about, betting on the team rather than the individual share, the individual player, then you're covered whatever happens. If the market does well, then you're going to make some money. And that's basically where everybody should start their investment journey. And one of the other great things about investing into funds is that they tend to be very low cost. If you're investing into a tracker fund, an exchange traded fund, an ETF, those vehicles have been structured to make it easy to invest into. So they tend to have the lowest costs out of all of the different investments in the market. So whilst it can be very exciting to invest into an individual share, and you'll hear stories when you're out and about talking to people about investing, how they made a fantastic investment. They put $100 into some share and it's now worth $10,000. But generally speaking, those people aren't telling you about the other 99 investments that they made into other individual shares that didn't do so well. So experienced investors will be investing into individual shares, and I do that, and I'll talk about that in some other videos. But for the start of your journey, you definitely should not be investing into individual shares. It is too high risk, it's too volatile, and it could potentially mean that the value of your investment goes down in a short space of time. If something happens in that company or in that sector that that company operates in, or something comes out the woodwork that nobody's expecting, the share price can drop like a stone. So don't invest in individual shares, invest into the markets. So the next question is obviously, what markets should you invest into? Well, this really comes down now to your personal strategy, what you're looking to achieve through your investments. And we talked about doubling your money earlier in the video, which is obviously a great goal for everybody to set. But at this point in your investment journey, you can now start having some influence, deciding on where you want to invest that money. Because we've got lots and lots of different options in terms of funds that you can invest into. So I would suggest picking a geography as a starting point. Which area of the world would you like to invest into first? Now, if you're based in the USA, you might want to start by investing into the USA. And a great starting point is the S&P 500 that I mentioned earlier in the video, because the S&P 500 is basically the 500 largest companies that are listed on the stock market in the USA. So you're covered by investing into the 500 best companies in the USA. So if you think that the US economy is going to do well, if you think that the outlook is decent over the next 10 or 20 years, then you can put your money in and sit back and watch that compounding start to benefit your net worth. Now, the other thing when you're putting money into a fund is all about timing, because what you don't want to do is put all of your money in on day one, and that turns out to be the high point in the market. And the following day, we have a Black Monday event where something happens which causes all of the stock markets around the world to crash by 20 or 30%. And you're then sitting nursing losses for the next few years. What you should do is phase your money in, put it in gradually. So if you had $1,000, for example, rather than putting it all in on day one, you might want to put that in 10 chunks of $100 each. And at this point, I'd quickly remind you about the costs. You need to look into what the costs are of any of the platforms that you're using. Make sure that you're not paying a high initial fee on every single one of those investments, because if you were paying $10 every time you make an investment, then clearly if you make 10 investments, that would cost you $100. So you'd lose $100 from your $1,000 pot. So you need to look into the costs. Make sure you've got a very low cost platform that isn't charging you any initial fees. And then you can drip feed the money in. And the reason why you're drip feeding the money in over 10 months rather than putting it all in 1 month is because it averages out the cost. So if the market starts to go down, then you benefit, because as the market falls, the price falls. And therefore, for your $100 that you're putting in each month, you're getting more shares. Or if the market goes up over that 10-month period, then each month you're paying a little bit more, but you've got the satisfaction of knowing that your initial investment has grown in value, and as you put more money in and the market keeps rising, it's going up and up and up, and so you can constantly see your pot getting bigger. So you should definitely spread the investment over a period of time. And if your income goes up, and if you have more net worth and you've got a bit more spare cash, then maybe you can increase the amount you're investing from $100 per month to $150 or maybe $200. $100, and as time goes on, it just becomes a regular thing. And as I've talked about in other videos, what you should think about for that investing is to try and allocate that money at the start of each month. So rather than thinking, well, I'll put some money in if I've got any left at the end of the month, and at the end of the month you find out that you don't have any money left and therefore you don't make the investment, put it in at the start. So set aside $100 right at the start when you get paid, put it into the market, and then it's just there growing for you for the long term. But obviously the S&P 500 isn't the only index that you can invest into in the USA. In fact, there are literally hundreds and thousands of different funds that you could find and invest into. So another very popular example is the NASDAQ 100. And the NASDAQ is the market in the USA that is made up predominantly of tech stocks. So these are obviously stocks that have the potential to grow very rapidly. They are also potentially higher risk, because if a tech business gets it right, great. But if it gets it wrong, if its technology suddenly becomes outdated or nobody wants to use it anymore, then those shares can drop very rapidly. And the NASDAQ 100 is an index that looks at the top 100 companies listed on NASDAQ. So basically, it's the best of all of the NASDAQ companies. And over the past 5 years, the NASDAQ 100 has grown by more than 20%. Then that compares to around 15% to the S&P 500. So over the past 5 years, the NASDAQ 100 has done better than the S&P 500, but that doesn't mean that it will continue to do better going forward. There is more risk in the NASDAQ 100, generally speaking, than there is in the S&P 500. For starters, there are 500 companies in the S&P 500, so you've got a bigger portfolio to spread your risk across. And those 500 companies include some big businesses that make things that are being sold on a daily basis. Whereas the NASDAQ 100 is obviously only 100 companies, and it's predominantly tech stocks, and they can come in and out of favour. But the point of mentioning these two indexes is that it gives you a flavour of the sort of thing that you can be investing into. And if you go online and have a look at the ETFs, the exchange traded funds, for the NASDAQ 100 and the S&P 500. The online data and research will show you which companies that fund is invested into. So you can do your own research. You can start seeing which businesses you'll have exposure to, because your money is going to be invested with those companies. That's basically how this works. You're investing into those entities. So you need to make sure that you're happy with that sort of exposure and you think that long term that company has good prospects. But obviously, it's not just the USA that you can invest into. You can invest into the UK or Europe or South America or China or the whole of the world, anything that you like. Literally, the possibilities are almost endless. And what I want you to take away from this video is that you need to start thinking about where you'd like to deploy your money. Do you just want to invest in the biggest 500 companies in the USA? Do you want to invest in the top 100 companies in the UK, the FTSE 100? Would you like to invest in the 600 largest companies in Europe? There are so many different options. You need to think about geographically where you want to invest. Then, when you've picked your geography, think about which sectors you'd like to invest into. Are you looking to invest into just a broad spread of all the big companies, or do you want to invest into tech or healthcare or retail or whatever you like? You can work out the strategy and you will be able to find an ETF that somebody is investing into, and you can put your money into that and then start sitting back and watching the compound growth over the next 5, 10, 15, 20, 25 years. So what's the summary and conclusion today? Well, I wanted to make this video because it's really important when you're thinking about investment to start your journey. You have to start somewhere. And I think the takeaways from today's video is that firstly, you need to make sure that you've got some sort of cash safety net. Don't be investing every single penny that you have and leave yourself short in the event of some sort of emergency. Once you've got that, you then need to think about the costs involved in making those investments. So don't go with a platform that's going to charge you lots of money, because that's going to wipe out your returns. Work out your strategy. The strategy we've talked about today is long-term steady growth. So pick some of the markets that you think are going to grow. I don't think that anybody watching this video should be investing into individual shares, because it's too high risk. And at the start of your investment journey, you want to get something that's going to grow nice and steadily. Pick an exchange traded fund, so basically a market that you're investing into, and do it on a regular basis. Don't put all your money in on one day. Spread it out over a period of time, and as it starts to grow, you may feel that you're enjoying it, you're liking the idea, and you might start to increase the amount that you're investing. So hopefully you found today's video useful, informative, and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and please check out some of my other videos on investing.